Can a great trader be taught? Or is it a talent you're born with? This was the million-dollar question that sparked one of the most legendary experiments in financial history. In the early 1980s, two superstar traders, Richard Dennis and William Eckhardt, found themselves on opposite sides of this debate. Dennis, who had turned a tiny loan into a massive fortune, was convinced he could teach anyone to trade. Eckhardt, his longtime friend and business partner, was skeptical. He believed trading was an innate gift, a kind of sixth sense. To settle their argument once and for all, they decided to put it to the ultimate test. They would create traders from scratch. This wasn't just a friendly bet, it was the birth of the iconic Turtle Traders experiment. The name came from a trip Dennis took to Singapore, where he saw turtle farms and thought, "We are going to grow traders, just like they grow turtles in Singapore." The plan was simple, yet audacious. Find a group of ordinary people, teach them a specific set of trading rules, give them real money to trade, and see what happens. The first step was finding their turtles. They placed a now-famous ad in the Wall Street Journal, looking for trainees. The response was overwhelming. Over 1,000 people from all walks of life applied for a chance to learn from a trading legend. The selection process was intense. Dennis and Eckhardt weren't looking for Wall Street insiders or finance prodigies. In fact, they preferred people with no prior trading experience. They wanted a blank slate. The applicants were put through a series of true or false questions designed to gauge their appetite for risk and their ability to think in terms of probabilities. After sifting through the mountain of applications, they selected a diverse group of 23 individuals. This group was anything but typical. It included a professional blackjack player, a pianist, an Air Force pilot, an accountant, and even a Dungeons & Dragons game designer. They were men and women from different backgrounds, united only by their desire to learn and their willingness to take a chance. The chosen few were brought to Chicago for an intensive 2-week training program. This wasn't your average classroom lecture. They were being taught the exact system that had made Richard Dennis a multimillionaire. The core of his strategy was trend following. The idea is that markets move in trends, and if you can identify and ride those trends, you can make a lot of money. The rules were mechanical and precise, leaving little room for emotion or guesswork. For example, a key rule was to buy when a market made a new 20-day high and sell short when it hit a new 20-day low. It was a simple breakout system designed to catch the beginning of major moves, whether up or down. But the system was more than just entry signals. A huge part of the training focused on risk management. This was the secret sauce. Dennis taught them how to manage their money with absolute discipline. They learned to calculate their position size based on market volatility, using a concept called the average true range, or ATR. This ensured that they risked only a small, predefined percentage of their capital on any single trade. No matter how confident they were, no single losing trade could ever wipe them out. This discipline was non-negotiable. They were also taught a technique called pyramiding, adding to their winning positions. When a trade was working and the trend was strong, they were instructed to increase their exposure, maximizing their profits on the big winners. After the 2-week boot camp, the real test began. Dennis gave his newly minted Turtles trading accounts funded with his own money. We're talking about accounts ranging from $500,000 to $2 million each. Imagine that pressure. You're trading with a legend's personal fortune, using a system you just learned a few weeks ago. The rules were clear. Follow the system no matter what. If the system said buy, you buy. If it said sell, you sell. If it said take a loss, you take the loss immediately. There was no room for gut feelings, fear, or greed. It was a purely mechanical approach to the markets. The first few months were tough. Trend-following systems are notorious for having long periods of small, consecutive losses, known as drawdowns. The markets would chop back and forth, hitting their entry points only to reverse and trigger their stop losses. It was mentally grueling. Many of the turtles started to doubt themselves and the system. They were losing money, Richard Dennis's money. This is where the psychology of trading kicked in. Could they stick to the rules even when it felt like the system was broken? This was the real test of discipline. Dennis and Eckhardt knew this would happen. The system was designed to make its money on a few massive, runaway trends that would more than pay for all the small losses. The challenge was having the mental fortitude to keep executing the plan while waiting for those big moves. And then, the trends came. The markets started to move, and the turtles who had stuck to the rules started to see their accounts grow. A big move in the Swiss franc, a rally in coffee, a crash in crude oil. The system was designed to catch these outliers. When a market broke out and ran, the turtles were on board. They rode these trends for all they were worth, pyramiding their positions and racking up massive profits. The small losses they had endured for months were quickly erased and dwarfed by these spectacular winners. The power of the system was becoming crystal clear, the discipline was paying off, and the profits were starting to pile up. So, what were the final results? Over the next 5 years, the turtle traders reportedly earned a staggering aggregate profit of over $175 million. Some individual turtles became multimillionaires themselves. The experiment was an overwhelming success. Richard Dennis had proven his point beyond a shadow of a doubt. Great traders could indeed be made. He had taken a diverse group of novices, taught them a rule-based system, and turned them into world-class traders. He had won his bet with William Eckhart in the most spectacular fashion possible. The results were so impressive that they became the stuff of legend on Wall Street. The story of the turtle traders had a profound and lasting impact on the world of finance. It popularized the idea of systematic or algorithmic trading. It showed that you don't need to be a Wall Street genius or have a magic crystal ball to succeed in the markets. What you need is a system with a positive expectancy, a statistical edge, and, more importantly, the discipline to execute that system flawlessly over and over again. The legacy of the turtles is a message of empowerment. It tells us that with the right education, a sound methodology, and unwavering discipline, trading success is an achievable goal, not just an innate gift reserved for a chosen few. The rules of the turtle system have since been published and are widely known. But the secret ingredient was always the one thing that can't be easily copied: the mental discipline to follow those rules day in and day out, through wins and losses. That was the ultimate lesson from the turtles. Thank you so much for watching. If you found this story as fascinating as I do, please hit that like button and subscribe for more deep dives into the world of finance and trading. Let me know in the comments what you think. Are traders born or made? I'd love to hear your thoughts. See you in the next video.